Hello, Daniel.
It's good to be back then.
Oh, I didn't ask you to come back, so I'm glad you're enjoying yourself. No, what are we talking about today?
Fed meetings and rate cuts impact on personal finances, the do's and don'ts for your first home purchase, and real estate or the stock market, where to invest your extra money.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. All right, these are nicely related topics here, so come at me. What do we want to do in terms of Fed meetings and rate cuts and all that fun stuff? What's the question here?
So, the Fed's meeting today and tomorrow to come to a decision on rates and if they'll cut them, and if so, how much. I know that a lot of people know what the Fed is and they know it's an important position and somewhat understand what rate increases and rate cuts do for the economy, but maybe don't understand how it impacts their personal financial situation, if at all. So, first and foremost, Fed's meeting today and tomorrow. We'll probably get an announcement sometime tomorrow. Should clients be paying attention to this news?
Somewhat. And I'm always cautious about telling clients to pay attention to economic or financial markets data because that leads you down the road to temptation to paying too much attention and getting too involved in it. But the Fed rate is one of those key financial variables in markets and the economy that actually has a really broad impact. And it's such a broad impact that it's actually kind of worth paying attention to. So, contextually, right, the Fed really has sort of three primary roles. Number one is the printing of money and the lending of money to financial institutions. That lending of money is where the Fed rate comes from. The Fed rate is what the Federal Reserve will charge banks to borrow money. And so it's sort of a borrower of last reserve because banks are supposed to lend out depositors money, right? That's sort of supposed to be the business model, but they will lend money in a pinch. The second element is that they are supposed to accomplish full employment. Now, full employment doesn't mean that 100% of US working adults have a job. It means typically that unemployment is 5% or less. Unemployment's tricky because we track that through unemployment claims. So there can be circumstances where unemployment looks low, but that's because so many people have fallen off the labor market. But functionally, if unemployment is at 5% or below, we're considered to have full employment. And then the last mandate is to control inflation. The money printing thing and the lending function has been, pretty well established for quite a while here. That's not really in question. We've had full employment essentially since the recovery from COVID, going back to 2021, 2022. And so inflation has been the hot topic for really the better part of the last 2 or 3 years. We saw inflation jump from a historic kind of 2%, 2.25% range, all the way up to just shy of 10%, and then begin to sort of taper back down. But that was a big system shock, and so that's been a really critical element of why the Fed raised rates very aggressively over the course of really kind of the prior 2 years. And then in turn, now that we've been at higher rates for a while, inflation is now kind of getting down to about 2.5% or so. And so there's now an impetus to say, hey, we don't want rates to be super high if they don't have to be, because the lower rates are, the more the economy can be juiced by lower cost borrowing. And so in that context, the Fed now is presented with an opportunity to cut rates. And the big question on everybody's mind is not if they'll cut rates, it's whether they'll do 0.25% or 0.5%.
Okay. And the market's open already today as of recording this. When the Fed comes out with that decision, whether it is a decrease of 25 or 50 basis points, how does that information get baked into the stock market and returns that clients are getting?
Sure. So first and foremost, the stock market is a forward-looking mechanism. So a lot of the decision, quote unquote, has already been baked in, but it's in gradation. Some people are the bear case and they don't think the Fed's actually going to cut rates. A lot of people, I would say the majority of people, have priced in 0.25% cut, which then will affect bond prices. It'll affect financial institutions, stock values. It'll affect highly sensitive or cyclical sectors like technology. And then some have a really bullish case, and that bullish case is that they'll do 0.5%. So the answer to the question here is, if wherever it lands, right, those people will be happy that they are where they are. They've already sort of made their bets in accordance with it. And then everybody who is off of the target, so if they do 0.25% instead of 0.5%, we'll see a pullback from the 0.5% crowd. And we'll see a sort of a jump ahead from the bear crowd that didn't think it was going to happen. If it's 0.5%, then the people who are at a quarter or at no rate cut will then sort of have to play catch up. So you always see a kind of some sharp volatility as the market resets major bets, right? As some people pan out as being the winners or losers of those bets.
Okay, I think that's a really interesting point you bring up there. So for the most part, you're saying that the information has already been taken into account, and that these investors and people buying into the market already know there will be some sort of rate increase or decrease. Apologies.
Yep. And the place where you look at this, the most sensitive category to Fed rate changes is going to be the bond market. There's a calculation called modified duration that essentially accounts for the effect on a bond's price if the Fed rate, which we in the United States treat as sort of the risk-free rate, it's sort of the floor of all interest rates and lending and so on. There's a calculation that essentially tells us, hey, if interest rates rise, here's how much you can expect the price of a bond to fall. And if interest rates fall, here's how much you can expect the price of a bond to rise. And so that sort of thing will be shaken out pretty much immediately because the prices of bonds are heavily reflective of the risk-free interest rate environment. In turn, for stocks, again, it really becomes more sector specific, right? Sectors that thrive on borrowed money, like technology, will see a big movement. You'll see a bigger movement in financial sectors because financial sectors are completely based upon interest rate considerations and lending rates and so on. But you won't see as much of a movement in places like utilities or agriculture, something like that, where these are what we consider defensive sectors, where people got to turn on the lights, people got to eat regardless of the economic circumstances, and so they're just less affected by those sorts of things.
Great. So let's say that the Fed does make one of these respective changes tomorrow. What changes, if any, should folks make to their own financial situation based off of the information provided?
I mean, at this point, your bets are probably already functionally placed. By the time you're listening to this recording, right, the Fed will have made its decision 4 or 5 days ago. At that particular stage, right, the thing people really need to be mindful of is their exposure to things like duration in their portfolio. So, for example, if you have long-term bonds, you're going to be more positively or negatively impacted by interest rate changes than if you have short-term bonds. If you've been betting really heavily on leveraged companies that borrow a lot of money, the interest rates being cut more dramatically will be good for you. In turn, if you've been betting against that, if you thought the Fed's going to hold steady, then you might be a little bit behind the curve. But this is where we get sort of into the point where I'm always want to kind of hint at being cautious about following the market or following news around the market. I don't know that a lot of people should be running around making portfolio changes. I think the bigger and more salient impacts of a Fed rate change are going to be things like the rates on mortgages, the things like rates on auto loans, credit card rates. Can you now potentially refi? Is a home a little bit more affordable to buy, and so on? Because all of those things are downstream of changes to the Fed rate. And I think those are more day-to-day consumption decisions that matter a lot more to the average listener.
So let's stay with that for a moment here, Dan. Let's say somebody's carrying some high interest debt and news comes out that the Fed will be lowering interest rates. At what point in time do you advise to refinance versus simply just continue paying that debt down?
It's going to depend on the transactional cost of refinancing. So some refinancing is essentially free. For example, certain mortgages will come with little riders or options to refinance your rate down, within, let's say, two years of your initial financing. And so, from an economist standpoint, the answer here is going to be, hey, if you can reduce your rate and it doesn't cost you anything to do it, just do it immediately. There's no reason not to. Now, there's obviously some time and energy effort costs that come into this, but just from a purely financial standpoint, if rates come down and it costs you nothing to refinance your rates down, you should do that. Now, the applied reality here is a lot of people will do something like refinance credit card debt, and I say that in quote marks, by taking out a promotional credit card at a 0% teaser rate for 15 months and moving their $6,000 of credit card debt onto the 0% teaser rate card, which will usually come with a 3% fee typically because that's the actual cost of the transfer, the transaction through payment networks. But that said, if the 3% is lower than, let's say, your 25% interest rate on your credit card, then that technically works. But if you had the cash to just pay off the lump sum, then that might just be a better strategy. When it comes to your house or an auto loan or something like that, with your home, I don't know that you want to go refinance over a 0.25% move. It's not necessarily big enough. I think you may be better off either waiting for a more significant move, something like 1% over the next couple of potential rate cuts, or you maybe just be better off holding out until the next sort of economic drop comes, because most people who are going to refinance a mortgage are going to end up with transactional and closing costs, a couple $1,000s out of pocket, which might equate to several months of interest on their mortgage. And so, from that standpoint alone, the recouping cost of a refinance might take you a couple of years to break even on the extra cost versus the interest saved. So something like a 0.25% move is probably not enough to move on. 0.5% could be. I think it really needs to get closer to 1% or more before the economics on that start to shake out in your favor.
Excellent. I think that's a great place to leave it because it segues perfectly into our next topic here, which is the do's and don'ts of your first home purchase. So for the most part, I think there's 3 decisions that you're going to make in your life that disproportionately impact the quality of your life more than others. One of which being what you decide to do for work or a career, who you want to spend your life with, if with anybody, and where you want to live. So today I want to focus on that third one, which is where you decide to live, because it's a very important decision and there's a multitude of variables that come into play, whether it's financing options, the location or the size or the purchase price, that all can heavily impact your finances long term. So I wanted to start by just asking, what are some of the things that a lot of people don't take into consideration when it comes to purchasing a home?
Sure. I think the first thing is a lot of people sort of live in a bit of a la land around what's required to get into a home, and they don't really find out what's required until they're actually serious about it, which may actually present a pretty significant opportunity cost to them. So let me explain that. A very common statement or sort of myth that's out there is you'll hear you need 20% down for a home. And that comes from the fact that most mortgages that are going to be offered with less than 20% down are going to require PMI, which is mortgage insurance, essentially protecting the lender against the possibility that you default in the first couple of years because they've extended you so much credit as a ratio of what you are buying with it. This is certainly a cost that you'd like to avoid if you can, but at the end of the day, it's just a cost and it's part of the financial calculation. The reality is, for something like a conventional mortgage, you can get into a home with as little as 3 to 3.5% down. But if you want to look at things like FHA first-time home buyer programs, VA loans, here in Colorado we have what's called CHFA. There's USDA loans where you can buy properties that have sort of an agricultural element to them. You have all sorts of first-time home buyer programs, grants, etc. So the first thing is, even if you don't have a down payment today, is just to go do homework on the various lending programs that you could be eligible for that may subsidize or completely pay for the down payment. I think a lot of people are renting because they're like, well, I can't really save the down payment. Okay, that's obviously a challenge to overcome, but the irony is a lot of people are paying equal to or greater than a mortgage to rent somewhere in certain circumstances. So it can make a lot of sense for somebody to just say, hey, if I have any inkling that I'm going to be here for 5, 6, 7 years at least, and I'm not going to be moving or relocating for any reason, then it makes a lot of sense to start paying really close attention to the housing market and to get a better handle on how you might be able to afford the down payment piece of it. The second issue that arises is going to be sort of the inverse of this, which is potentially making yourself house poor.
What is house poor?
Well, thanks for asking, Daniel. Being house poor is essentially borrowing so much or buying so much home that you can't afford it. So when I say that, there are a ton of ratio tests that go into purchasing a home. For example, most lenders want your mortgage payment to be less than 28 to 36% of your gross income. Right. So if you earn $100,000 a year, they don't want you spending more than $28,000 to $36,000 a year on your housing costs. Now, they'll also combine in other liabilities, so regular credit card payments, student loan debt, auto loans, et cetera. And there, they really want to see it kind of all combined be less than 40%. because you have to account for the fact that they're assuming that you're paying about 20 to 30% of your income in taxes. So then if you, let's say, have a 40% cost of debt service with a mortgage plus 30% taxes, then you're trying to live on 30%, right? You're just trying to eat and pay your bills and everything else with the remaining 30%. And that's financially stressful and challenging. The other thing then is that when you run those calculations, sometimes, right, a lender will say, hey, you're qualified for $700,000, $800,000, $900,000. Okay, they're saying that by their calculation, you can afford that. That doesn't mean that you're going to be comfortable buying that much house or having a payment that translates to that much house or that expensive of a house, right? Because sometimes you can spend $1 million on a pretty nice house in Longmont, or you can spend $1 million on a garden shed in Boulder. So it becomes a question then of how much house and so on. But in that particular context, right, being house poor is somebody who's saying, hey, I'm going to buy so much house, right, or as much house as they'll possibly lend me, because then I've purchased a really valuable asset. But then you become house poor in the sense that so much of your income goes towards that debt service, that in turn it makes it difficult not only just to have a plain quality of life, but it can also make it difficult to do things like save for your retirement, save for your kids' college, pay off other types of debt that might even be higher interest than your home, because your home just sort of dominates your financial picture. The good news is that usually your housing cost as a percentage of your income will go down over time, because the mortgage amortization itself is a fixed cost. Your insurance costs and your property tax may go up, but those are usually not going to go up, quite in tandem with your other cost of living adjustments.
I think you brought up a really interesting point there very quickly about how, people will purchase or justify this large acquisition because it's an asset. And they say, well, I'm buying this asset, it's going to be fruitful for my future, etc. However, oftentimes we'll, tell clients, hey, it might not be your most fruitful investment from a return on investment standpoint. There are better places to save if we want to. However, I think it presents an interesting dichotomy between, purchasing what you consider to be a worthy investment versus just buying what you consider to be your forever home. How do you weigh, if something is a wise purchase versus, hey, I just want to buy it because it's where I see myself living forever?
I think honestly that is actually the question sort of answers itself here, right? Where you should not think of where you live as a financial asset in the sense that it needs to get a good return on investment. It'd be nice if it did, and often it can get a good return on investment, but I think it's a very poor consumption decision to look at your home as a financial asset in the same way you would look at buying a stock or an ETF or something like that. And in turn, right, if you're financializing your home, if you're really trying to min max the costs and increase the actual return on it, real estate is frankly not actually that strong of an asset for that purchase, or at least your personal residence style of real estate is probably not the optimal asset for that type of investment. So I really think it just helps to bifurcate that decision. I'll give you a really good local example. So, back to the crash in 2008. A fond memory for you when I think you were 7 or 8 years old at the time. But in 2008, right, the real estate market really crashed out, and home prices in the city of Boulder on average dipped from something like 360,000 to 330,000. Okay, so kind of the lowest they've been in a long time. And at that point, since then, what I have heard people say over and over and over again about real estate in Boulder is, wow, I wish I owned real estate in Boulder. I wish I lived there. I wish I owned rental properties there. I wish I had as much Boulder real estate as I could possibly have ever afforded. Because in the time since 2008, the average price of a home in Boulder has gone from, call it the low 300,000s up to around $1 million. And so you look at that and go like, wow, that's 3xing the money. That's incredible. Okay, that's not wrong. And if you wanted to live in Boulder, 2008 would have been the time to buy, right? It really would have been the most affordable it's ever been. But when you actually look at the compounding annualized rate of return since that time, the return on Boulder real estate has really only been maybe 2% above the rate of inflation on an annualized basis. Bearing in mind inflation over that most of that time period, other than about 2 years ago, was very, very low. So the net of inflation, the real rate of return on Boulder real estate has not actually been that high. It's just that the prices themselves were kind of big to start with. And as time goes on and big numbers compound, they just compound into bigger, more dramatic numbers. In turn, right, the stock market in the same timeline, more than 4x'd. And so in the same context, right, you look at Boulder real estate like, man, I wish I'd had, a $300,000 house could be worth $1 million today. Well, $300,000 in the stock market, going back 16 years today would be worth substantially more than that house in Boulder. So it's just a matter of saying, again, if you want to live somewhere, buying a home is a good strategy for reducing or kind of better controlling your cost of real estate. There are some variables that can mess with that, right? Insurance costs in Florida is a good example where hurricane costs have just driven the cost of homeowners insurance through the roof. But in a localized sense, if you think I'm going to be a long-term resident of this area, buying a home can be a really good strategy to go ahead and stabilize that cost. And thinking about it as a financial investment should be a secondary consideration because, again, your primary residence specifically doesn't tend to have a very strong return on investment.
I think that's really interesting is, just this concept of compounding and, large numbers look more attractive for compounding than maybe some smaller numbers do. And maybe that's, partially the reason why some of these families and individuals might think that the real estate does better than it might be doing.
Well, I mean, it's sort of the interesting observation, right? You can get, let's say, a 10% rate of return on a duplex in, Joplin, Missouri, and it's going to, do okay. But then, at the end of the day, right, even though the rate of return might be 6, 7, 8%, you started with a purchase price of something like $150,000. So then even if it compounds over 10 years, it's only going to be worth, let's say, $250 to $350. In turn, right, if you bought a place in California or in the San Francisco Bay Area or downtown Manhattan and the same percentages are applied, but you had to pay $2 million for it, right, the dollar amount of the return is going to be substantially greater simply because the starting number was bigger, even if the rates of growth are exactly the same. So big numbers tend to confuse us a little bit. Human beings have a cognitive bias called hyperbolic discounting, in which we're sort of bad at mentally accounting for compounding math. And so from that standpoint, right, it's very easy to let big numbers at the start create big numbers at the end and then assume that was somehow superior from a gross rate of return standpoint.
I think something worth mentioning as well, Dan, is that, if someone has a primary residence, more often than not, they're going to hold on to it for 30 years. But that seems to be a pretty difficult feat for a lot of families and individuals when it comes to the market.
Well, and actually, I'm going to push back on that a little bit because the average home buyer tends to have a real estate transaction approximately every 6 to 7 years. So this is actually where primary residents can struggle quite a bit. Is people think like, okay, I bought a home, this is my forever home. I would never move, I would never leave, I would never buy a bigger house, downsize to a smaller house. And yet, statistically, right, in the average population, people are changing out their housing situation essentially more than once a decade. And so when you account for that, it would math out better if you bought one home and stayed in it for all 30 years. So you got a 30-year mortgage, it's stable, it's great. But the fact of the matter is the majority of people don't. And that's part of the problem with the real estate transaction is that you have very high transaction costs, right? You're typically paying somewhere in the neighborhood of 6 to 8% in a real estate transaction if you're on the selling side. This gets a little bit messy because the buyer technically is paying for everything because they're borrowing the money and putting in the down payment, and then the cost of like agents and closing fees, whatnot, gets baked into the buyer's costs or the total cost of the thing. It's weird. You can sort of slice and dice it a little bit, but at the end of the day, you have very high transaction costs. It typically is going to take no less than 5 or 6 years to recoup those. And again, back to the average, by the time those costs are functionally being recouped, the average home buyer is preparing to engage in another real estate transaction. So if you want to improve your rate of return, the answer here is you should stay in a home longer term. But life is messy, right? People get new jobs, change jobs, they have kids, their kids move out, an older relative, like a parent, needs to move in. There's all sorts of weird reasons that people will engage in these transactions that make them financially suboptimal. It's why, by comparison, investment real estate, when it's not your primary residence, can actually be a very strong asset. But personal residences tend to suffer from a lot of transactional costs and a lot of hidden costs that we otherwise may not incur in other types of investments.
It's almost like what topics I'm going to be talking about, because coincidentally, the third topic I was going to talk about today was real estate that isn't your primary residence versus investing in the stock market. So let's say, someone comes to us or somebody that has a considerable sum of money that they'd like to invest for themselves at a future date. It seems to me that a lot of our clients or even people I run into on the streets have very strong opinions on this conversation. It's either I love real estate and I'm anti stock market, or it's some inverse of that. Uh, but they both have positives and they both have drawbacks, and I wanted to talk about them today. Why does it always seem that people go one way or the other in this conversation?
Well, first and foremost, directly held real estate has one feature that the stock market tends to lack, which is a tangibility. The stock market is somewhat esoteric. It's ambiguous. It's this invisible pile of ones and zeros in the internet, and that can just sort of feel not real. It can feel sort of scary and dangerous to people. And there's this entire media empire, right, across multiple news platforms dedicated to reporting the good and the bad and ginning up a great deal of anxiety around the good and the bad, right? Hey, good things are happening. Are you in on it? Are you missing out? You should be getting in, right? You're missing out. Or things bad, the market went down by half a point, right? And they'll use words like plummeted, dropped, fell, very dramatic, visceral things. And we have a negativity bias as human beings, right? Our feelings of negativity at loss tend to be 2 times greater than our feelings of positivity at gain. So the negativity around the stock market can leave a lot of people feeling anxious, and in turn, right, real estate can feel safer, right? Well, even if the whole real estate market crashed out and my land and my house or whatever that tangible asset is worthless, I still have the asset, I still have the house, I still have the land, and that just feels safer in a basic human sense.
This reminds me of a comment you made once about how the stock market's open every single day during the week. So we see the prices go up and down in real time every second of the day. If real estate was similar, say somebody was out in front of your house and every day they said your house is worth this much today, and then they came back the next day and said now it's worth this much. People might interpret those fluctuations a little bit differently, but because it doesn't happen that way, and these changes in prices are less periodic, I think it creates a different perspective for some people when it comes to just viewing the fluctuations of the returns.
Well, and let's exaggerate that for a second. I mean, imagine if the value of your home was on an app on your phone and it was constantly showing you had made or lost thousands of dollars every day in bright green or bright red numbers, right? You would not feel quite so secure about the value of the real estate. But I think the ironic thing here is because we're investment professionals, right? We're both investment advisor representatives, hold or have held those licenses. We engage in financial planning daily. We manage tens of millions of dollars for our clients. And so it's funny because I'm going to say something that's going to sound a little bit contradictory to common wisdom, which is to be successful at stock market investing requires substantially less of a skill set than being successful at real estate investing.
Anything else you want to share on that?
Well, I mean, I can certainly explain it, but if you're going to let me get away with it at face value, then no further comment.
No, I don't think I am. There's a lot of really smart people out there that sit in a lot of really important buildings doing a lot of financial models for stocks and whatnot. How can you say that it takes more complexity in real estate than it does in the stock market?
To be successful, let's actually be key about that, right? To be successful in investing in the stock market is substantially easier than it is in the real estate market. So let me simplify being successful in the stock market. To be successful in the stock market, you must open an account. You must deposit money into that account, either one time or on a regular basis, on a going basis. You must pick, and this is probably the hardest part of this, and it's ironic because some people are going to comment or say that this is actually the easiest part, but you must pick some low-cost index funds, right? So talking about things like S&P 500 index funds or ETFs, talking about Russell 1000s or total stock market things, right? But go pick some low-cost, kind of broad market ETFs or mutual funds or other products that do that. Buy those consistently over time and do nothing else. Right? And if you can do that, and that sounds very simple, but if you can do that, you will probably have a very strong financial outcome as a result of it. Just on a gross return basis over time, that's probably going to work out for you pretty well. Now, the complicating factor there tends to be emotional. It tends to be behavioral, right? It's maintaining investment discipline over time. It is, in total fairness, picking some of the stronger investments at the outset, which people like to say things like VTI and chill or VOO and chill or SPX and chill. But at the end of the day, just be mindful example that it's very easy to pick the wrong investments, but just in a long-term investing standpoint, right? If somebody's an 18-year-old and says, what should I do to be financially successful the rest of my lifetime? My answer is just buy low-cost index funds and don't stop doing that until you have the money you want or need. So I say it's easier because people are bad at doing that, and the actual like literal steps in the way that I might say like making coffee is not that hard, right? Like that's not a hard sequence of events. Again, doing it correctly and consistently over time and following the appropriate things to make sure that you keep a healthy balance going forward and that you're not engaging in foolish financial behaviors is the harder part of that. But that's very simple. In turn, right, the myth here would be for a lot of people that buying real estate is super easy because you just, you buy a house, you buy an apartment, you buy a duplex, whatever. You borrow other people's money to do it. And then you get some people to come rent from you, and then they rent and they pay off the mortgage and the taxes and the costs for you. And the property appreciates in value over time, and you collect the rent checks, and over time you can raise the rents, and you just get more and more money. And then you have both cash flow and tax advantages from depreciation and expense write-offs and appreciation. And it's super great and it's wonderful and it's all going to work out well. And I don't think anything could be further from the truth.
How so?
Well, I mean, take into account the distinguishing differences here. So let's compare again the person opening the account in a financial institution and investing in broad index funds and just doing that consistently over time versus the person buying real estate. So step one for the stock market side, open an account. It's going to take you 3 minutes on a platform like Charles Schwab, Fidelity, or Vanguard to open that account. Okay. In turn, if you want to buy a house, well, number one, you're going to need a down payment. So you got to save up a lot of money up front that you can't necessarily reinvest or get a good yielding rate of return on while you build up that down payment. Number two, you then have to purchase the tangible asset, which involves a lot of cost of search, a lot of time, a lot of energy, and you've purchased the tangible asset. And for the purposes of our example here, we're just going to say it is a single family home that you're purchasing for a reasonable amount of money. You're borrowing every dollar you can borrow to do it. Okay, so right away we have higher costs of entry. We have higher transactional costs going into it. We have much more significant time and energy costs that go into it. And then we've introduced leverage. And leverage in an investing context for real estate is very normalized because essentially every American, for the most part, borrows some amount of money to purchase their primary residence. So it's very normal to borrow money for real estate because the price per unit is so high. But in the stock market, utilizing leverage is considered a high-risk strategy. Margin accounts are a high-risk thing. And quite literally, there are instances, for example, during the pandemic, there was a kid, I want to say in Idaho, who inadvertently utilized margin an account and found himself owing $400,000 at the age of like 19 or 20 and killed himself, right? And ironically, right, to owe, let's say, $400,000 on a house would not be considered scary. But, it's just the change of context. The tangible asset and the normalization of borrowing money for real estate makes it not seem scary. But the fact of the matter is, right, you might be 10% into a asset, 90% in debt on that asset, and it's still in the hundreds of thousands of dollars. So just to start, our point of entry for real estate takes a lot more energy, a lot more money, and is much higher risk than just a systematic ongoing purchase into index funds or similar products that provide that sort of outcome and result.
That's fair, and I definitely would agree with that sentiment. However, I want to propose just a scenario to you. Let's say somebody realizes they can't invest their own money. They don't have the temperament or the knowledge or the time, or maybe they just don't want to do it. So they say, I'm going to hire a professional. Maybe that professional charges a percentage of what they manage, or maybe they charge that individual a flat fee. Either way, they're hiring somebody. Let's say someone else decides to say, I want to invest in real estate. I don't want to do it myself. I'm going to hire a property manager to take a lot of the overhead off of my responsibility plate. Net of taxes or even just fees, how do those returns compare?
That's going to be a tough question to answer because we're actually taking two very different calculations of how that functions. So a common investment management fee might be something like 1% of a portfolio. If you have a kind of full-time, highly qualified investment manager, it can be a lot lower, like 1/4% or 1/3%. If you're just utilizing an automated robo-advisor type platform. So your costs can vary there. Property managers tend to charge somewhere in the neighborhood of about 10%. I've seen it as high as 15%. I've seen it as as low as 7%. But they tend to charge that on cash flow, whereas the investment managers tend to charge it on the overall asset value. So you've got a very different comparison there. But I think in both cases, you're paying for a service, right? You are offloading the time, energy, effort, and knowledge burden of professional management onto a third party. So the irony is, right, a lot of people will attack financial advisors or financial planners to say, like, well, all you do is stick stuff in index funds, and you don't really generate a lot of excess return or any excess return. And if I just did it myself, I would do better. Well, the same thing applies to the property management thing. If you're willing to sacrifice time, energy, effort, and knowledge and not hire a property manager, congratulations, you get a higher rate of return on your asset. You then just have to spend the time, energy, and effort to do it, and you have to gain the knowledge to do it correctly. So, in terms of gross rate of return, I don't know that I really want to get into a financial comparison there, because both of them are costs that are not necessarily offset by improved returns so much as being offset by improved quality of life for the people engaging those services. But there is the sort of risk angle, which is, let's say you decide you're going to self-manage your property. Do you know all of the laws about being a landlord? Do you know all of the code requirements for updates and maintenance and upkeep and so on? Do you have appropriate contracts and so on? Right. So do you manage your property legally and correctly? If so, great, you're going to net out wonderfully. And if you don't, the cost of errors could be substantially more than the cost of ever hiring those professionals to manage the property for you. And in turn, the same thing applies in the investment side, right? People say, like, well, it is so easy to do it yourself. And I just said that myself, right? It is so much easier to do it yourself in the stock market than it is in the real estate side. But at the same time, statistically, the data shows that people tend to mess it up a lot. And so the cost of the professional is going to drag on returns, but the cost of doing it wrong is substantially greater than the cost of the professional. So you have to have a high level of confidence and potentially overconfidence in some cases in order to see the rewards of just doing it yourself in either circumstance.
Fair enough, Dan. I appreciate it.
Well, and I just want to extend this a little bit because you actually are sort of letting me off the hook here. I pointed out that the cost of entry is really high and challenging, and that it's much higher risk than it was. But that was just the cost of entry. The ongoing assumptions are also a problematic element. And you touched on this somewhat through the hiring of professionals, right? You can offload that call at 2 a.m. to a property manager. You can offload the stress of picking the exact funds and rebalancing when you need to swap a fund out to a professional portfolio manager. But then there's the ongoing element and the assumptions that go with it. Back to an argument for simplicity, and back to a point where I say that you need to have a much stronger skill set to do well in real estate investing. Again, a lot of Americans tend to focus in on the single family home, the duplex, the fourplex, or a very small apartment building or something like that. But there is a huge variety of real estate asset classes. You have commercial real estate, right? It can be offices, it can be industrial, it can be storage space. You've got different investment characteristics in those the same way that you do in the broader stock market. And you have professional product managers, right? People who run syndicates or private equity or accredited investor real estate offerings to develop apartments or develop office buildings or to buy a portfolio of those assets, do improvements to them, and then resell them after improving the financial characteristics. There's a whole industry here. And the funny thing is, you can invest in all of that through the stock market. You can go buy real estate investment trusts. You can go buy real estate mutual funds or ETFs. You can go buy SMAs of directly held real estate or private equity real estate portfolios, right? So all of this is a big circular conversation, because if there was any particular asset class, right, whether it was precious metals or real estate or cryptocurrency or the stock market itself or bonds or whatever, if there was any particular asset class that fundamentally on a risk-adjusted basis outperformed everything else, right? Just across the board, all the evidence just shows that XYZ is just the best possible investment of all time, then that's where all the money would go. But the fact of the matter is, right, for every reward, there was a risk taken. For every asset class, there are pros and there are cons. And so when somebody says something like, hey, should I invest in real estate or the stock market? I like to point out that real estate is just a subset of the stock market, and that your mileage will vary. I think directly held real estate is a classic example of a highly volatile asset. And when I say volatile, I'm talking about a range of deviation from the average return, where you hear stories about people who invest in real estate at the right time in the right place who just make money hand over fist. But there's a survivorship bias there. The people who lost their shirts don't tend to advertise it very loudly. right? And the survivorship bias means that if they do poorly, tend to fail out. And the same thing can happen in the stock market. But on a risk-adjusted basis, I'm always going to point somebody to the lowest level of effort required to obtain an optimal level of risk and return.
I really appreciate you bringing the point up about the ongoing costs, because I do think that is something worth mentioning. Like you mentioned, you can get into the stock market and, buy and chill essentially. But in real estate, a lot of our clients that do those investments themselves, believe it or not, they spend a lot of time with those investments and working on those investments. So for a lot of folks, they have to ask themselves like, hey, in my retirement or in my off time when I'm not working my 9 to 5, do I want to spend time on, these real estate investments, or would I just prefer to have things in the market that, I don't frankly have to touch or look at all that much?
Well, and back to the experience, the knowledge thing here, we have some clients who are heavily invested in real estate, right? They've developed real estate, they've done syndicated investments, they own multiple real estate properties, both commercial, residential, and so on directly, and they're crushing it. These are also incredibly talented, incredibly smart, incredibly thorough, hardworking people who made it their thing. They really doubled down and tripled down on it. It wasn't a casual hobby or exercise, right? They flipped houses, they bought rental properties, they did improvements, they've started entire companies around it. And so they're doing very well because they are professionals doing it. So again, it's not to say that any asset class is intrinsically good, intrinsically bad. Real estate can be an incredibly strong asset class, but it definitely requires a lot more sweat equity and knowledge to get good at and to build genuinely outperforming results long term. And that never mitigates the risk, right? The risk adjusted return is something we always have to keep in mind here. But back to my original sort of thesis here, if you're just going to say, hey, I've got a lot of money, what should I do with it? I'm always going to try to direct you to the lower costs and the lower time energy options, unless you can demonstrate to me or show me that you have a unique or powerful skill set that's going to give you a unique and powerful advantage in a very select asset class like real estate.
Appreciate it, Dan.
Well, with those fun topics out of the way here, Daniel, I'm going to have to ask you the question, as I always do. What have you learned in the last couple of weeks that you think is important for our audience to know?
I've recently realized our audience also does include other financial professionals, and it's not just, clients or folks that are interested in personal finance. So I wanted to share something a little bit, more geared toward those professionals in the industry. I think that early in my career, I tried to avoid messing up as much as possible. And I'm still very early in my career, and I still do make a lot of mistakes. And, there's still a lot of things that I learn and, internalize on a daily basis. And I think one of the mindset shifts that I've made recently is, just saying, hey, you will mess up, and it's okay to mess up. What's not okay is saying that this mess up will happen again and not learning from it. I think if you can just have the belief in yourself that, I'm a competent individual and I believe that I'll get through, this little hiccup or whatever, is a much better mindset to have than trying to avoid messing up in this career.
Very good wisdom to share with the audience. And I don't think I could have timed a mess up in articulation better if I tried.
You might have been able to. Don't sell yourself short there.
I will endeavor to fuck up more than anybody else as consistently as possible, so you can all learn from my example. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of these subjects, strategies, or tactics discussed on the podcast.